Well, this thing is telling me that I'm live, so I guess I'm just going to have to go in a little faith here and believe it. Thanks for joining us on our inaugural Facebook Live. This could be the most exciting 8 minutes, 10 minutes that you've ever had in your life, or this could be arguably the worst 10 minutes you've ever had in your life, Brandon.
I'm going to go with worst, but let's.
Well, I hope that everyone will have a little patience with us. I've got a lot of stuff to monitor here on the screen and paying attention to the camera and staying in frame and all those various things. But I think this is working. And today, what we wanted to do really in 2019, one of the big goals that Brandon and I had was to bring more content to you consistently, much like we used to do. And we've even gotten some messages from people saying, you used to write these really great long posts and you don't do that as much anymore. And so, this is an effort for us to try to bring you the type of information that you tell us that you want to hear. And also it's serving a dual purpose because, we've got to have a shameless promotion in here for our book, Predictable Profits, which I'm going to adeptly hold up in front of the screen. You too can have your very own version of Predictable Profits. If you go to ipblive.com, that'll send you right over to the page where you can read more about Predictable Profits. All right, enough of that. Let's get on with it. Today, we're going to talk to you about, Brandon.
We're going to talk about whole life insurance dividends, and specifically the best option within whole life dividends to accumulate the most amount of cash value in your whole life policy.
Oh, that sounds exciting.
I can't wait. I'm super excited. But I want to also take a moment to thank everybody who kind of watches us do this and experiences the stumble of our foray into live broadcasting.
For everyone that watches us trip and fall, yes.
Yeah, I took a note just recently that I got to figure out how I cough away from the microphone more eloquently than I did during your introduction, because when we're podcasting, I can do whatever I want, but when the camera's facing me, not so much. So
I know
again,
this is a little tougher because you have to put on clothes.
I know.
Hair.
Mama always said I got a face for radio, so here we are. So
exactly. So we're talking about dividend options today. Is that?
Yes, correct.
All right.
The best dividend option for cash accumulation, without drawing this out to some lengthy introduction, is simply the option to purchase paid up additions. Correct?
Right. Absolutely.
Traditionally speaking, for the purists out there are four options for dividends, and I know if you're familiar with some other whole life insurance products that are issued out there are more than four found within their list of possibilities. But by and large, for the last 100 years, there's always been four traditional options, and then we kind of introduced a fifth one a couple decades ago to purchase term insurance. But generally, we've got paid up additions, paid in cash, reduce the premium, and accumulated interest.
Okay.
And paid up additions is the one that we are going to focus in on today, because that is the option that allows us to accumulate the most amount of cash within a whole life insurance policy.
And that's the one we see people use more often than any other, right?
Well, it's the one you and I see ourselves using more often than any other.
That's what I meant. Yeah.
There's been plenty of times people have come to us with old whole life products that they purchased decades ago. Mm-hmm. And they'll make comments about the cash not really accumulating in a way that they thought it should have. And when we look at it, what we oftentimes see is cash is basically the guaranteed cash amount because they've been taking the dividend in cash for all these years.
Right.
So paid up additions, how does this work? The dividend award for the year purchases paid up additions on the whole life policy. The reason this accumulates more cash is because paid up additions themselves increase your policy. And the increasing of your policy puts you in a place where you are paid more dividends from the whole life policy.
Okay.
That was not very eloquent, but it is a way of effectively compounding non-guaranteed values in a whole life policy. Dividend purchases paid up additions. Those paid up additions themselves will earn dividends. So those dividends can purchase more paid up additions and the cycle repeats.
Right.
I want to note when we say this, that there was a brief period of time in the 80s when it actually might have been a better option to take the accumulated interest dividend feature. This is simply a matter of taking the dividend, placing it in an interest-bearing account, and benefiting from the interest paid from the insurance company.
Right.
You can't put any additional money in there. It's just the dividend that gets paid there. There's an
Right.
interest rate that gets paid on that. And when we saw super high double-digit interest rates, there might have been a high enough payment of interest and then taxes due on the interest payment to overcome the accumulation of values from paid up additions. But this was a short period of time, and long term, it didn't work out better at all.
Right.
So
right.
while that feature was somewhat coveted for a short number of years, many years ago, that is no longer the case. It's unlikely that'll become the case anytime in the near future. And paid up additions is absolutely the option that you would want to choose for maximizing cash value inside a whole life policy.
Okay.
We do have a little tip for people. And the tip, as I kind of forgot what it was, so I need to look at my notes.
As you elegantly look in your notes.
Look at that. It's so there are likely
I'll help
to
you out,
be
but I
times-
can't see because I don't have my glasses on, so I can't.
and I refuse to take mine off. So
Right.
there is a time when we try to design policies that will maximize cash accumulation.
Right.
And we will not be able to choose the paid up additions option for the dividend. Instead, we have to choose a sort of specialized option for the purpose of term blending. And in that case, that's okay. That doesn't mean that we're at some sort of disadvantage because we're having to choose that dividend option.
Right.
We want that to happen. There's no way around that. What we do want to make sure of, though, is that our secondary dividend option that we choose is, in fact, the paid up addition. So what that means is part of the dividend will pay for the term insurance that's necessary for the design, but any excess amount over that will go towards paid up additions. That will ensure maximum design and optimal cash performance for the policyholder.
Right. Okay. That makes sense.
We oftentimes get asked a question when we explain this to people in a more one-on-one setting. And that question is, so if I choose at some point in the future to take my dividend and use it to pay my premium, because I've heard you can do that. And I mean, yep, you can. If the dividend amount is higher than the premium, you could absolutely have the dividend pay the premium due on the whole life policy. So if I do that, am I now putting myself at a disadvantage for cash accumulation? And the answer in a very, very strict sense is a little bit. But reasonably speaking, there will always come a time when what you do with your whole life policy and your dividend option will be less optimal. What I mean by that is you will run into a point where you're no longer worried about maximizing every dollar that you accumulate from premiums paid. Yes, it's true that for most whole life policies, they become more efficient at generating cash with your premium dollars as time goes on. But there will come a time when that really doesn't matter. You've retired. You don't have income anymore. You don't have money to put towards premiums. It's not going to matter to you anymore that you're not being able to efficiently turn those dollars into cash value in the policy.
Right.
And again, as we went with the little tip before, using the dividend to pay premiums and then having the paid up additions option as a secondary election is perfectly fine. That means that any excess amount over the premium will go towards paid up additions, and that will optimize cash as much as possible.
Right. Okay. So we can choose different options depending on sort of what time period we are. I realize I've got to keep my hands here so that I'm in frame. But so you might choose a different option at a different time depending on sort of where your client is or where you are in your life cycle with your policy.
Things change. It's as simple as that.
Okay. How are we on time since you're keeping track of my time?
Not much to belabor on this one. I think we're pretty good.
Okay.
You already gave them the website, IPB. I realized that could mess people up. That stands for Insurance Pro Blog, just shortened.
Yeah,
so
exactly.
IPBlive.com is where you can go to check out Predictable Profits if you'd like to, which is a great book. We've gotten amazingly great feedback on it, and it will tell you things about whole life insurance that are quite wonderful.
Right. Yeah, if
And
you
I
head
think
over to ipblive.com, you'll learn everything about it. We got some great bonuses that come with the book, the paperback and the digital version, but there's also some great bonuses. We did a live case study recording. Just go over there, read all about it, pick it up if you want to. And we plan on doing these pretty regularly. Again,
yeah,
I wasn't looking at the camera when I said that, so I probably should
that's
do that.
okay.
We plan to do these at least a few times a week, depending on what the response is. So if you've got something you would like for us to share, feel free to comment here on the page, send us a message, send us an email. I think everyone knows how to get in touch with us. So,
Yeah, cool.
all right. Thanks so much. Talk to you guys soon.